All right. Good afternoon. Good morning, everybody. Welcome to our technical analysis class today. My name is David Settle, of course. Today's April the 3rd. Glad to have everybody here on board as always. Hope you're all healthy and everybody's doing well. You're not doing too crazy mentally as you're trying to stay healthy physically. So we have it here. I think I told you yesterday. We have it here now in my little town, our little hospital. At least our health department has told us that we have it here now in our little town. So whatever precautions we were taking here at the Settle household has now even been that much more dramatic. So we're stuck. I'm stuck here inside the house, and it's too cold outside. And I think Annette, I think you all got the storms that we had here. We woke up yesterday morning. There's still snow on my front yard because we're a north face house, and we still have snow in our front yard. But yesterday it's completely covered with snow, and so I think that came through and went over your way here. So, but hopefully we warm up, we get some sun. I'm looking out next couple of weeks, and rains in the forecast, but at least we're not, today's low at 28. We're not dipping that low anymore. Makes me jealous for all of you that live in the South where I used to live, and we didn't have to deal with this white stuff so much. But anyway, let's take a look at what's going on here today in the markets. So give me 1 second to do that. Cold, and 60 degrees in Tampa is cold, huh? No, we don't get hurricanes. We definitely don't get hurricanes. We do get, apparently, if you can ask Brandon about it, we do get earthquakes, that's for sure. In fact, a couple of days ago, not only did we have an earthquake here in Salt Lake City, in Salt Lake Valley, but we also had one relatively close by in Boise, close to Boise. So, we live relatively close to this like tremendously huge volcano that's up there in Wyoming and Montana. That from the expectations of, yeah, we got the trumpet fell off, exactly, Roger. From this idea that Yellowstone will blow, and whenever that might happen, and then everybody here in Utah is expecting the one big earthquake to happen. It's like, holy cow, pandemics and earthquakes, and who knows? Crazy world. Crazy world that we live in. Jobless claims hitting millions, and unemployment rate jumping up 4.4%. It's interesting. Again, like you can see, like we're down today 2%, but that's like we're inside the range of the last couple of days, even with this downward move. I showed you this chart before, the daily price moves. We're I mean, look at that. We're just the down. I mean, we weren't going to not have downward moves, right? The question wasn't to avoid the downward moves. The question was to not get them so big anymore. So like I think we're starting to lose now. Now we might ramp up one or two times like we did this week, even a couple of days ago. We might have a downward and upward move. But remember, I mean, the VIX is falling, and historical volatility is still extremely elevated, right? Still extremely elevated. So that gap typically gets filled, and it usually gets filled with volatility rising. Now, I don't think volatility is probably not going to rise to 90. The VIX isn't going to get to 96%, right? So I don't think the VIX is going to make that big of a jump, but can it make a big jump back into the 60s, 70s, maybe even up to 80 again? Probably, right? But most likely it's going to take the historical volatility to start falling first, based on what we've seen in the past. And so, which means slow moves, right? The historical volatility falling that means that things are going to really slow down, small moves, small upward moves, small downward moves, right? And right now we're getting a small downward move, and that's just fine, right? That's just fine. We just had 2 days. So here we are. We closed on Wednesday at 2470. We just had 2 days. Stocks slide after the jobs report. I kind of find that funny. We've had 2 days now of really bad employment data, like really, really bad employment data, like 6 million some odd jobless claims, 4.4 million, or 4.4% unemployment rate. Extreme numbers, and keep in mind too. So this is something to keep in mind. This is David Settle speaking, so take this for what it's worth about this unemployment rate. The unemployment rate is a survey number, first of all, right? It's it's a survey that gets answered, number one. And number two, so it's not actual based on hard data, it's a soft data, it's a survey number. Jobless claims is an actual hard data. It's actually how many people claimed for unemployment insurance. But considering like back in 08, 09, when the unemployment rate jumped up, if you remember, a lot of people left the workforce in 08, 09. If you remember that, I mean, that's the difference, I think, between then and now. I don't think there's a lot of people leaving the workforce right now. People are losing their jobs, but I don't think they're leaving the workforce. See, in 08, 09, it was a big shift, right? It was, like the industries were shutting down and robotics and AI and, there was a lot of chatter about how, people need to change their jobs. Right? They're not going to go back to the same jobs that they lost because the economy's changing. So people left the workforce. And when I say they left the workforce, I mean that they stopped looking for jobs, because you're technically not unemployed unless you, number one, don't have a job, and number two, you're looking for one, right? You're only counted as unemployed if you're looking for a job. If you're not looking for a job, you're not unemployed. Isn't that interesting? If you're not working and you're not looking for a job, you're not unemployed, you're just not anything, according to that survey. So that's where the other, the marginal, and there's other things too, like marginally attached to the workforce. How are you working? You're working short hours, whatever, right? There's a U6 unemployment rate that includes those. But the U3, I believe, is the headline number that a lot of people look at. So that the unemployment rate, my opinion here, is going to really skyrocket. I don't know if it's going to be 30%, and I saw that number out there. I don't know if it's going to be 30%, but I think it's going to really skyrocket. And here's the reason why. Because I don't think people are going to be leaving the workforce. I think there's going to be a lot of people looking to get right back in, if that makes sense. So it went up in 08, 09, but I think it's going to go up a lot more right now. And it's going to be quick, and it's going to be sudden, and it's going to recover just that much quickly too, if people get right back in the workforce once this virus is eradicated. At least not eradicated, but at least the curve has been flattened and people can get going and get back in again. Now, once if and when there's ever a vaccine, that's gonna just really cover everything. So that's kind of what I'm seeing here when I see that number. And and I'm not alone in this, because it's 2470 was Wednesday's close, and right now we're at 2486. So in 2 days with really bad employment data points, we're up 16 points in the S&P 500. In 2 days after two really, really bad employment data points, the S&P is actually up 16 points. Right, 16 points. So keep that in mind in terms of why the stocks slide because of the jobs, the employment number. No, stocks are sliding because there's pressure. I mean, we're in a bearish type of market, and that's what I'm going to talk about a little bit today. But that's the type of market we're in. But the nice thing is that we're not, the ranges are falling. Where's the range? the ranges are falling, or this isn't it, but the ranges are falling, and we're not closing, right at the lows of these really, really bad moves. This is what I wanted to show you. I wanted to do this one, 4G. I know we have a lot of monthly subscribers that have been coming on. Again, all these charts here, all of our premium subscribers have access to all these scripts. So you have, this is 4G. This is all coming on. This is all part of the premium package there. But this ATR, you notice the ATR still, like today's range is not, there's no gap here that we have to worry about because it's been filled in. So there's no gap here, very, very small gap early. No gap. Look how small the range is relative to the average. 6.97 points. To kind of give you an idea here of how that relates to this. Let's see here. 6.97 at 247.20. That's less than 3%. Now the day is not over with, right? And we could get more of a move. The day's not over. But that's 3%. That's down to here. And remember, we don't start really to form. This is David Settle's technical analysis take here. We don't really start to form the low point until the ATR drops closer to 3%. Right, and there's lots of examples of that. You go back to 2008, 2009. 2008, 2009, you can see there's the 3% mark. Again, by the time we formed the low point, we had dropped from these really high levels that where we're at right now down to 3%. And you look at 1987, that low point, and that one's got to be SPX. Sorry, we got my wife is a teacher. She's in the background. Hopefully you can't hear her too loudly, but she's running her class right now over Zoom. So we got two classes going on at the same time here at the Settle household. Both of us are teachers, just teaching different things. So here's the ATR to price ratio here, and you notice, again, by the time we formed the low point, we had come down from these extreme highs all the way down to 3%. By the time we formed the low. Now the low, the Black Monday was the low point. We just retested it. But the low point that we bounced off of, we had come down to 3%. I don't know why that's not showing here. Oh, because it's not on SPY this way. So we've got a long ways to go to get down to 3%. We're at 5.25%, and so what that means is we're going to get a lot of 2 to 3% moves. We're going to get a lot of moves that are up and down inside of these at least inside of the pink lines, if not inside of the orange lines. A lot of these moves to bring the ATR down, and it's going to be up and it's going to be down. And I told you before, I think the VIX. Whoops. Shoot. Where'd that go? The VIX has still got some room, to fall too, right? So everybody who attends my option inventory trading, you know what we're looking for here. We're looking for this to get down towards 1, whether that happens today or maybe Monday. We're looking for it to get towards 100%, and at that point, we're going to look to buy calendar spreads. And we even talked about that on Wednesday, where we were looking for the VIX itself to get down towards the high 40s, right? Because that's what it would take with VIX 3M, which is what this ratio is at the bottom, with VIX 3M already in the high 40s, and it's not going to be falling as much, right? So it's kind of hovering here in the high 40s, which means to get the VIX down to 100%, then we're looking for a few more points to the downside, right? And at that point, we look to buy calendars. Right, so and usually that coincides with a drop, with an increase, an increase in prices here. Whether or not we'll increase back up towards, I mean, just even today's high was at 253. We're 6 points off of today's high point on SPY. You know, you go out to the 5-day mark, just this last, you know, this past week here. So this would be last Friday going into Monday. There's still this gap that we haven't filled in yet. But if we rally up just to today's high point and start to fill in that gap towards 260, of course, that would lead to a drop in the VIX, more than likely. In that class, Jay, we teach the calendars. We typically go out of the money or in the money, right? If we're going to do double calendars, it's going to be right around the 30 to 40 delta. Right around the 30 to 40 delta is what we look for. But then it's also going to be dictated around. It's also going to be dictated around where our inventory is, right? How our inventory is currently set up and where we might need them. For considering that in May, we're just barely starting, we can pretty much put them anywhere right now. 4G, let's see here, what was 4G? And what's the difference in the lower graphs? Yeah, that's why. They should all, that's why I brought them up. These two, and the VIX, these two, like, Dwayne asked a good question here, and especially for those that are new, I'll kind of explain what these are really quickly. They're all measures of volatility. So consider it that way. Consider they're all measures of volatility. So what are some things that we look at that measure volatility levels? Well, you have average volume, right? Because average volume spikes in times of volatility and it drops, and you can see lots of examples of that over the past 10 years. You can see every time it jumps in periods of volatility, and then it falls back down, jumps, falls back down, jumps, falls back down. Now, even in 2011, 2011 jumps and then falls back down as the markets jump up again. So down here at the bottom is ATR. ATR is average true range. There's a calculation here involved, and I won't get into it. That's not the topic of the day. But essentially, it's how big the ranges are on average over the last 14 days, and it includes the gaps, right? Because there's gaps, overnight gaps, so it tries to include those. But that's the range, right? And so again, when volatility spikes, the ranges get bigger. When we fall down, when the market goes down, we see that here. When the market goes down, the moves get bigger. When the market goes up, the moves get smaller. See, the market goes down, the moves get bigger. And then they go up, the moves get smaller. Market goes down, the moves get bigger. Even on the small scale. And of course, on a big scale, markets go down, the moves get bigger until they stop getting bigger. As we're dropping, and that's why, here we talked about the likelihood of a really big upward day. Well, we got that the very next day because the moves were getting smaller going into that Monday after March expiration. So, and as we bounce back up, the moves get smaller. So that's what average range. And of course, the VIX itself, when we drop, the VIX spikes. When we fall, the VIX comes down. And that's where this is another measure, very similar to volume, very similar to average true range. When volatility jumps, when market drops, volatility jumps, and then it slowly comes down. So have you noticed that pattern? If you notice that pattern there, like when we drop, volatility, trading ranges, average volumes, they all jump really quickly. And then they slowly come back down. They jump up, then they slowly come back down. They jump up, then they slowly come back down, right? And when they jump up, that doesn't always set the low point, right? That doesn't always set the low on that first huge jump spike in volatility. That doesn't always set the low point because then we retest, with these subsequent little bounces. Here's, going back to 2011, we jump up and then we slowly come back down. But during this time, we retested lows as we kind of bounced up off of these support levels. So same thing. The VIX measures volatility in the 30 days. VIX 3M measures volatility over 90 days. So the VIX in the back month, in 90 days, volatility This is a question that came to me privately. The volatility in 90 days should be bigger because, again, the VIX measures expectations. How volatile is the market going to be over the next 30 days? We don't know, but the market prices in expectations. And so that's what the VIX measures, is how volatile the market expects the markets, the options markets, expect the S&P to be over the next 30 days. VIX 3M, 3-month VIX here, that's how much the market expects, or the options markets expect the S&P to be volatile in the next 90 days. It should be higher in 90 days than in 30, right? Because there's 60 more days of uncertainty, of not knowing what's going to happen. So volatility expectation should always be higher in 90 days than 30. But that's not always the case. When the market goes really haywire, everybody's worried about the here and now. And so the volatility in the next 30 days is a lot bigger, because then they expect things to eventually settle down over 90 days. So it gets smaller in 90 and bigger in 30, because they don't know what's going to happen next week. Are we going to fall off? Are we going to continue dropping like a rock? So you get a big jump up in the VIX as well as this VIX ratio here, and then we slowly come back down. If you look at the Bollinger Bandwidth, it's very similar, a very similar indicator. Go back over 10 years. We get a big move to the downside. The VIX jumps up, or the bandwidth jumps up, and then it slowly comes back down to these lower levels. It jumps up, and then it slowly comes back down. But you notice there's a subsequent little bounces here and there, but it jumps up, and it slowly comes back down. It jumps up, and then it slowly comes back down. It jumps up, slowly comes back. So you see how they all kind of work together here. If you look at the DMI, which is kind of another bandwidth indicator, and let's go back out 10 years. When we get these big jumps in volatility, it happens quickly, and then we start to come back down. Big jump up, the purple line jumps up really fast, the blue line falls, and then we settle. You see how the purple line comes back down. Same thing, big jump up, and then but then we had a subsequent jump up on December, but then we slowly come back down. And here's an intermediate drop. Big jump up, got above 40, we got below 10, and then we started to come back down. So that's why, the big jump up was actually way over here, and then we had the Saudi oil war, and kind of similar to what we had in December, kind of this anomaly that really roiled the markets, and we got a kind of another big jump up where the positive index, and now we've been slowly coming back down. Now we're going to bounce back up again, right? According to everything we've seen, even though we get these big spikes in volatility right off the bat, we typically retest the lows, and everybody's been talking about that ad nauseum, and then we jump back down again. So that's why I look at a lot of these charts, because like in 4G, and I put these two on together because they, like you said, they typically move right hand in hand, even though they measure two different things. This measures average volumes, and this measures how big the ranges are. But the idea is, when we get these big jumps in volatility, I like to see how big they are, because then they tell me how long I can expect going forward there to be some choppiness before we get a new low point, right? If you recall, as you've been watching, we went from, okay, we're kind of expecting the intermediate line on the market forecast to double 50. It all started right before February expiration. Then we started to drop, and we're like, okay, now we're going to get the market sentiment line below 50 because we dropped so much. Then it was like, all right, now we're going to get a death cross because we dropped, we got to this low point. We're going to get a death cross now, which means it's going to take months to get, of choppiness before we really get going again. But we're going to get going again. And now we're like, okay, this is 1987 or 1929 type levels. We've really come down to extremes. It's going to take a long time, right? It's going to take months and months and months. But it doesn't necessarily mean that we're going to go to new lows, right? No. Like Dennis asks, is there any time these are ever different? And the answer is no, it doesn't. There's rarely any time where it's different. That's why I like to look at them together. And I would put the volatility index. In fact, I used to have the VIX ratio here, but Well, if you get too many charts, you can't see anything, right? So that's the beauty of, Brandon was the one who introduced me back in the day to using these grids up here. So that's the beauty of having, different charts on different grids. So I can just flip back and forth. But now I've got the VIX ratio on its own chart. I've got this chart. We've got the bandwidth chart. We've got the DMI chart. And we've got all these different charts that we look at to see. And again, the idea that I look at when I look at all these charts is how big the spike is going to be. Right? How big is the spike in volatility? Because that tells me how long it's going to take before we get, essentially, how long it's going to take before we get dark green shading and a green line here. How, essentially it's this scan that I've shown you before. Here's let me detach this and bring it over so you can see it. But if you see, I've got this high probability scan, right, that I've shown you before. High probability scan, which essentially is dark green shading and a green line in the market forecast. 3 green arrows on the MACD and the stochastics, which is what these are showing us, and then a golden cross. So dark green green shading. I wouldn't say I have most. I use all those charts a lot, Dwayne. If you get in the habit of watching my market outlook videos, you see which charts I use, and also when you watch this class, especially. And when you watch directional option strategies, you kind of see which charts I use the most. This is the golden cross. So all of these essentially are green shading, right? Because that's how they're coded here. You get green shading. You get green on this chart. You get green shading on this chart when you got 3 green arrows, right? So you get green shading here, and you got on the golden crossover green shading here. So this scan looks for green shading on all those charts, essentially. Looks for green shading in all those charts, and as well as a dark green line on the moving average for the market forecast. That's what it's looking at. So like if I run the scan right now, there's 5 stocks that fit that criteria. 5 stocks. If you take a look at, 2 of them are bond ETFs, and one of them is, if I were to go to look at this Gilead Sciences for an example, here's Gilead, which, interestingly enough, was in a bearish mode all of 2019 until this coronavirus hit, and now all of a sudden it's really bullish. And to kind of give you an idea, it's interesting that Gilead is as bullish as it is, and it's got some opportunity there. So it's got green shading. If I go to the market forecast chart, I've got green line and dark green shading here. Green line and dark green shading, and then you look at. Thanks, Dan, for sharing that. Then you look at the 3 green arrows. So Dwayne, Dan's got a resource there for you in the chat window. And anybody who's new as well. If anybody's new in here or newer recently, there's a good class in the chat window you might want to go back and watch the recording of. Gilead, look at there, 3 green arrows, right? A rising moving average. So I didn't think I'd have any stock. Honestly, I didn't think I'd have any results here. I didn't have any, but we actually had one. We actually have 3, and they're all kind of related to, the stay-at-home work from home situation, the coronavirus, and then, the food thing. So it's interesting how 3 different areas are all kind of doing well right now. There's Hormel, green shading here. Here it is on the market forecast, and then here it is on the crossover chart. So, yeah, Citrix was the other one, wasn't it? Citrix. So there's Citrix. Look at that little rally it's getting going here. Now, something to keep in mind. Something to keep in mind about um, something to keep in mind about Hakinyashi candles. This, as I've got it on my mind because I'm seeing it here. I've told you this before, but I'm sure you don't remember everything I ever say about all these different charts. So I'm just going to reiterate something really quickly on Hakinyashi candles. That's the thing I love about this class is I can just tell you everything I know about technical. This class for me on a technical analysis chart. This is like a data dump for me. I can just tell you everything I know, all my experience, everything I know about charts and how I read in this class. This gives me a lot of opportunity to do that. And I've told you this before, but I'll remind you on this. On bullish, these are Hakinyashi candles. On bullish moves, the biggest candles are at the beginning, and then they get smaller, right? The biggest candles are at the beginning, and then they get smaller. The biggest candles are at the beginning of the move, and then they get smaller. So the biggest candles are at the beginning of the move, which means the candles are going to start to get smaller, which means the moves up are going to get smaller. That's how it works with the bullish Hakinyashi candles. With the bearish Hakinyashi candles, it's the opposite. They start small, then the biggest candles are at the end, right? They start small, and then the biggest candles are at the end. So that's the opposite. That's the opposite. So how do you know when it's the end? When you stop closing below the prior week's candles, right? And you get that reversal. So just because you get a big candle doesn't mean, okay, I'm going to buy Citrix. Like if I got this candle right here. I say, oh, okay, that move's done because I had some small candles and whammo, I got a big candle. So I got that candle that downward move is done. Nope, I've got to make sure we don't close below that low on a Hakinyashi basis. I got to get a transition candle, which we did the next couple of weeks, and then we got the reversal. So that kind of lets us know from a Hakinyashi standpoint when to take that. And you got this big, you get the transition candles, and then you get the big candles to the upside, right? You get the transition candles, and then boom, big candles to the upside for a few weeks, and then it slows down. So that's kind of this. That stood out to me because we're getting really big candles right now in Citrix, which means that it's a weekly chart, so we're probably going to get weeks now of small candles to the upside. We're trading at 144.76. The high up, the close this week right now is 141.76. That's always a good sign when the actual close because the Hakinyashi close is not the actual close for this thing. The Hakinyashi close is an average of the actual open, high, low, and closes for whatever you're looking at. It's an average of 4 different prices. That's what the Hakinyashi close is. So when you look at Citrix open, high, low, and close for the week on this chart, right? On this chart, the open, high, low, and close, all for Citrix here this week. When you average out those 4 prices, that's what you get here, 141.76, and it's really good. It works in both directions. It's bullish when you are closing above the Hakinyashi close. It's bearish when you're closing below the Hakinyashi close, right? It's not as bearish when you're closing when you're going down. So again, another kind of thing about SPX here. First of all, if this is the week, if this ends up being like if we turn up next week, then you're going to look back and see that transition candle is like, holy moly, that was a great signal to tell us that we're going to at least make a run up to the 50-day moving average, right? At least make a run up to the 50-day moving average. In this case, we went through it, started to fill in the gap between the two, which is going to get bigger by the time we start to fill it. And then, again, testing the 200 will be the big question mark. What are we going to do when we get back to the 200-day moving average? So that is quite the transition candle. Now, again, we can get fake outs, right? Nothing's ever 100%. Here's some transition candles, transition candle, and then we kind of messed around a little bit more, and transition candles, and we still went bearish here. We still went down. So this doesn't necessarily mean like this, so we have to turn up next week. But still, usually with these big, nice, big range and small body candles typically lead to reversals. Typically, right? So this is something to keep an eye on going into next week. We could very well have a very good week. And if you look at, so if I were to look at, no, not at all, Emil. It just means that we might not retest next week, right? Again, did you see that tweet that, I don't know if you're on Twitter, if you saw the tweet that the back and forth that Brandon and I had? Long-term investors right now, it's just a matter of getting through all this, and I know I've shown you guys the charts before. When we had the big jump in spiking, when we had the big jump in October, the big spike in volatility in October 2008, that kind of second week of October, that's when we had the worst of the selling pressure. But then we went lower in November, and then we hit the low in March. So when the worst of the selling was over in October, we still fell 25% 5 months later from that October low point. But then we rallied, right? Over the next 7 months, we rallied so that we had a 1 year return from October to October of nearly 20%. Even though that 1 year return of 20% started with a 5 month drop of 25%, we still finished with a 1 year return of 20. So even if we do test the 50, that does not mean that we won't retest these lows. It just would mean that we don't retest it next week, the week after. Again, remember, it's this concept of bandwagons, right? If everybody's expecting us to retest the lows, because it is a high probability that we will, it just might not happen the way that everybody's expecting it to. And I would venture to guess we probably won't retest these lows until we get more people off that bandwagon, if that makes sense. That's kind of what I've been saying all week long here. So we'll see. We'll see what happens, right? The high probability is we'll retest those lows at some point. So I want to make perfectly clear that if we do rally here next week, that I don't think that we are out of the retesting lows. And we could V-bottom, right? We could very well V-bottom and just jump back up because nothing's ever 100%, nothing's ever 0%. I just don't expect that we will. I expect that we'll just knock people off the bandwagon first before we retest those lows. So does that answer your question? I just want to make sure I'm very, very clear because I don't want, when we do come back and touch these lows again, I don't want anybody to say, anybody that might have been listening in this class, to say, oh, well, David said that we wouldn't retest those lows anymore, right? The bandwagon concept, Martha, is that if everybody's expecting something to happen, it usually doesn't happen the way they think it will. That's the bandwagon concept. So the more and more you hear something on TV about a move, then even though it is high probability, because that's why everybody's talking about it, it might not move the way they think it will. All right. So, the market causes the most pain. Exactly. The market will just cause pain. And so it will retest these lows when people don't think it will. Right? If people are expecting to retest lows, it won't cause a lot of pain. So it won't happen the way you think it will. Market moves in a way, and I don't know how many of you have gotten that coronavirus test yet, but I don't know if I'm going to want to get that test. It looks worse. Anyway, I just saw that on TV right now. So next week's Hakinyashi Open, so the Open is the midpoint of the previous body. So the current body is 25, 40, 76 plus 25, 28, 34 divided by 2. So 25, 34 is where the Hakinyashi that's where the Hakinyashi Open will be next week. We are trading right now at 24.65, 15. So as of right now, we will have a bearish candle next week. It won't be a bullish one like this, as of right now. depending upon where we end up closing the day, because we are down 60 points. We would have been right at that open. But as of right now, next week's open will be the midpoint of this little tiny body, and then the week will open up, close to where we're here, 2466. That is, 90, 60 some odd points down. So there will be a little bit of a bearish body here. So we might end up with another transition candle. We might go down a little and then back up next week. So, a lot of times you'll open up, but again, the idea is, what I told you before is, are we going to close? Is the actual close above or below the Hakinyashi close? And right now it's below it. So that's a little bear. I mean, again, it's also below where next week's open is going to be, but it's a little, that's a little bit of a bearish bias there. Okay. A little bit of a bearish bias for the markets. So always kind of keep an eye on that in terms of where, and as I said before, Citrix is the opposite. Citrix right now, even as big as that candle is at 141.65 is where we're closing right now on the Hakinyashi close. The actual close for the stock is 144. So that's pretty bullish. Now, are we going to get does that mean we're going to get another big old candle next week? Probably not. We're going to start slowing down, especially with the PPO as high as it is. I mean, look how high PPO is. So if you're going to look at an entry on this, there's been other times where it's been more bullish. But interestingly enough, coming out of that recession, it was really bullish. But if you're going to look at an entry on this, you have to keep in mind that outside of these moves, these extreme moves, this is a pretty high momentum. So that it doesn't mean they can't go up anymore because it went up from here. It went up more. It just went up at a much slower pace. So expect smaller candles and a slower pace to the upside now on Citrix. What I would expect on a stock on a move pattern like this. Okay, I did want to bring up, here's another benefit that we have, and this is the topic of the day. Not this one, sorry, this one here. So for those who are not, for those who are InvestTools, old InvestTools clients of ours, back when Brandon and I used to work for InvestTools, and then obviously TD Ameritrade as well. This is our 3 green arrow pattern, here, and it's the 3 green arrows and the 3 red arrows. Very easy visual to see when should I buy and when should I sell. And we look at it a little bit differently than what all the salespeople, how they used to sell the system back in the day. We look at it a little bit differently here. But the concept is we have a momentum indicator, a price oscillator, which is stochastics, and then the moving average. So 3 different types of indicators, all giving us signals at the same time. That's the concept behind this 4D, which is, this is the one chart I probably use longer than any other chart for the longest time, because I started working with InvestTools back in 2004. So long time ago. We've been using this same system for a long time, and it's a good system when it's used right. And that's it wasn't always taught right because, the way that people use it. But I did want to talk about the stochastics. I think it's very relevant to what's going on right now, So as we get more bearish, there's a few things that I just told you earlier. The volatility spikes, the trading ranges spikes, and then volume spike, the DMI spikes, the Bollinger Bandwidth spikes. Those are all measures of volatility, right? Those are all measures of volatility. They all spike. You see if you remember what I taught you earlier in the class. So bring up your chats here. They all spike really quickly, and then what happens to all those volatility measures? They all spike really quickly, and then what happens? Good. They all start coming back down slowly. Right. Does that mean that price immediately bounces? Does that mean that price immediately bounces? No. Good, good. It might, it might form it might retest the low. It might form a little bit of a lower low and diverge. But usually volatility doesn't spike again. Not always, right? We had the December 24th move in 18. There's always nothing's ever 100% or 0%. So we had that December move where we did get another spike because the Fed raised interest rates when everybody in the world knew not to, and they did it anyway just because. I mean, it wouldn't even have like roiled the markets because it actually roiled the markets that they did. So there was no reason for them to, and the markets basically told them that they were wrong, and they immediately backtracked on that rate hike in December of 2018, and obviously we know what happened since then. So that was an example of another volatility spike that actually happened at the end of a bearish move. But again, it was kind of anomalous because it had a really tremendous policy mistake that caused it. All right, so well, guess what else spikes? You see these oscillators, and I've always shown you 6J. It's very prone to divergences, and that was one of the reasons why we were really bullish over here too, because we were expecting, a divergence, a move to come up, and we weren't expecting a bullish reversal, but we were expecting a kind of an up and down here. So in a little bit of a kind of a skew-wampus head and shoulders, if this is the left shoulder and this is the big old head and this is the right shoulder maybe. But anyway, will that be the type of pattern that gets us to the 200-day or at least a 30-day moving average on this bounce? But I also want to bring up the stochastic indicator and kind of talk about that here really quick. So now I'm going to go. I showed you for D. For E, breaks that stochastic indicator out so you can see it here. There's another thing that spikes when we have a big jump in volatility. When the volatility spikes and volume spike, trading ranges spikes, there's another thing that spikes too, and that is the stochastic really drops to the downside sharply. Really drops sharply to the downside. And the reason why is because as you drop down, we get bigger ranges, right? We typically get bigger ranges. And not only do we get bigger ranges, we knew about that, but we also close at the lows. When things are really, really bearish, we close at the lows of the day more often than we don't. And so that produces a really big downside stochastic. Let me bring, and I'll share another level of the stochastics here in just a second. So give me 1 second to bring that up. What did I lost? I lost the time in my chart here. Let's see here. So I needed to go back out. Sorry, to this chart. I want to show you here. So here's the big selling we had, and the stochastics jumped down. And I told you we had the one big spike here in stochastics that was kind of blow-off move in 2018. So that was the kind of the difference there. If I zoom in on this, you can see, we had here in May we had a big jump or drop in volatility, a spike in volatility. Initial spike was here, and then we got a little bit of a lower low. That's kind of an anomaly too. This is the typical pattern. The big drop, the most momentum, the biggest drop in volatility, and then we retest, but everything is low because we're not, here we hit these lows really hard with big ranges, and then we kind of, we don't hit the lows as hard. Maybe 1 or 2 days we get closer to the lows, but we have more days where we move off the lows, usually with bullish days because of it. And that's what brings the stochastics. You can see the lows start to grind up higher. This is a very, very common pattern on the stochastics. Let me go back to that 2008. Well, here's 2011. So the biggest drop, the biggest jump in momentum, the histogram is really big here. The stochastics drop down. And then we retest these lows, but not with nearly as much momentum, and the stochastic says we had one little kind of divergence, big a spike here, not as big on the momentum. Stochastics did drop down, but then, we were done, kind of like the December 2018 level. And I wanted to show you 2008 too, on the stochastics. Because again, what does stochastics measure? It measures where do we close in relation to the high and the low. So the bigger the range, the closer to the low, the lower the stochastics will be, right? The lower it will be, the closer to the lows that we finish. And we typically close at the lows on the bigger range days. That's there's a relationship there, as I've shown you with the ATR and all of that. So there's a relationship in all of this. Here's the big selling in October. That's when it was the worst of the worst, right? The worst of the worst there. That's when I tell you that, if you would have bought there and loaded up at the end of that week when things were as bad as they were, you would have been really good. Things would have been really good for you for a couple of days. But 5 months later, you'd have been down 25%. 5 months later, you'd be down 25%. 1 year later from this point, you'd be up 20%, even with that 25% drop. But you notice here, as we retested and hit the 30, and we actually retested the lows and went lower in November, you notice the stochastics wasn't nearly as low. The MACD wasn't nearly as low. We had a couple of days where we closed at the lows, but for the most part, smaller ranges. We had more up days in here. We're not as, there's more, we're not closing at the lows nearly as much. And so that is something to keep an eye on. And the reason why I bring it up now is because we've had the worst of the selling, right? We've had the worst of the selling here. We made new lows, but you see all the days that we came off of the lows. You see all these days? So the stochastics wasn't nearly as bad. The histogram on the MACD wasn't nearly as bad. And then we popped up here, and we've always see these pops up. And after these pops up and the MACD rolls over and the stochastics comes down, the stochastic will come down again. Where do I expect the next low point on the stochastics to be relative to what I see here? Where do I expect the next low point to be? Higher, exactly. And the reason why is because I'll be expecting us not to have so many days where we close at the low of the day, right? Where we close at the low of the day. Now today, so what does that mean today? Is there a chance that we might pop up? Yes. And if we do pop up, even just a little bit off of this low, closer to the high, that will be another sign that we're just not as bearish anymore. Yeah, the sellers are burned off. Exactly. The sellers are burned off. We're not as bearish anymore. And why does smaller range matter versus the bigger ranges? Because in a day like this, I can get closer to the high really easily than in a day like this. Whenever I close over here, like this big down day, it would take me a lot more of a rally at the very end to get closer to the high than it would this day. That's why the smaller ranges matter. Does that make sense? I still think that's a common gap. And yes, I do think, Martha, that will fill. There's a good chance that will fill in. I don't know when, but I still think there's a good chance. We filled in some of it the last couple of days, but I still think there's a good chance that we fill that in. We'll see, obviously. And nothing's ever 100%, so it doesn't have to. It doesn't have to do it, but that's what I expect. Right? So, look at the volume here today. We're having a down day. Look at the volume here. So we're going to this. There's going to be some way that we retest these lows, and it might be next week. It might not. We might fill in that volume gap first. But watch how we close. Watch that stochastic indicator, and how we close at the lows, because you'll start to see a lot of. Even if we do retest lows and get to lower lows, you'll start to see higher stochastics points. And we're in that mode right now. Here, let me go back. We're in that mode right now. So it's going to come back down below this. The orange line is a 5-day simple moving average of the blue line. That's what you see. Here. So you see it's over here on the left, you see the 14, and then the 5, and then the 5. So let me just briefly tell you what these numbers mean. The 14 means we're looking at the past 14 days on SPY, and we're trying to figure out, on average, where did we close in relation to the high or the low in the last 14 days on average. And then we sort that. We plot that on a scale of 0 to 100. So if we close every single day in the last 14 days at the high of the day, then we'd have 100 stochastics. If we close every single day over the last 14 days at the low of the day, we'd have a 0 stochastic. That's what the 0 to 100 scale tells us. But then that gets really choppy because, that we close all over the place. I mean, look at all these closes. We're all over the place. So that can get really choppy when you look at a 14 average. So we smooth that with a 5-day. So that's what the blue line is. The blue line is a 5-day moving average of the plot of where we're closing in the last 14 days. That's what the blue line is. So where are we closing in the last 14 days, graphed, and then smoothed with a 5-day average of that line. Okay? That's what the 14 and the 5. That's the blue line. The orange line is right where this number is a 5-day moving average of the blue line. So the orange line is a 5-day moving average of the blue line. The orange line actually evolved. The orange line actually evolved with the idea that the guy who created the stochastic, he did a 14 and a 3 was the original. And this was put together in conjunction with the MACD to try to have similar signals, right? That's kind of how these are all put together. But the original stochastics was a 14 and a 3, and the idea was that the signals were better when you smooth that 14-day line by 3 days. So we're like, okay, well then why don't we just, instead of putting on two different lines, the 14-day average and then a smooth 3-day average, why don't we just graph the 3-day average of the 14? So that's where the slow stochastics came in. The slow stochastics is the percent K is a 3-day moving average of that 14-day average, right? And so we've taken it, the full allows you to customize it however you want to do it. So we, instead of using 3, we use 5, and then instead of another 3-day, we use 5 too, because it lines up better with the MACD. Way back in the day when that was all put together. So in other words, so now what I'm kind of pointing out here is, yes, the crossover. Anna brings up this idea that we use a crossover buyer sell signal. Exactly. So we've hit the 17-day moving average. The blue is about to cross over the orange, right? Most likely. Now maybe not. We might get a little bit of a hiccup here, like I said, to kind of knock people off the bandwagon. But most likely, it looks like the blue line's about to cross down below the orange. Is that fair for everybody? Everybody kind of with me on that expectation that the blue line's going to cross over the orange? Yeah. So, and we're holding the 17-day. We're closing below the low of the high day. It looks like we're rolling over. So I showed you in the market outlook, and then we'll do it again today, that the higher probability trade in this scenario is because it's a high probability setup. So that leads to high probability strategy like a short call vertical spread. So we did one in the market outlook. We'll probably do one today again. That's kind of what I've been looking at for our trade, because it seems like that's the high probability. So I wanted to point that out because that's going to be coming up in the next. You're going to see a lot of these types of crossovers here on a lot of stocks because the S&P is about to get one. Okay, and when you do see them in a situation like this, again, high probability leads to high probability strategies, and we'll sell call verticals on that. But let me also tell you this, that at some point in time, we're going to, that stochastic is going to come down. The blue line is going to come down below the orange. It's going to form a higher low, just like you mentioned before, and then it's going to roll up and cross back above the orange. which will then be a good opportunity for some speculative bullish trades that you can expect. Okay, I might retest some lows. I want to give myself some time, but I might also be, it might be a lower low, but the stochastics is forming these higher lows. The selling pressure is abated. There might be a good run of at least up to the 200-day moving average on a long-term basis. That's going to be my bullish signal coming up here. So in the short term, when we get this bearish crossover, you're going to be able to get some short-term, high-probability bearish trades like those short call spreads that I mentioned in directional options this week, and I did in the market outlook on Wednesday, and I'll probably do today again. Okay, so that's going to be like in the next couple of days. That's kind of your higher probability setup to be watching for and scanning for, and then I'll post the scan today that shows you how to watch for these, to look for these crosses on this blue line crossing below the orange on the individual stocks. I'll post that in the forum again today for you. And then, so that's in the very short term. And then within the next week or two, you're going to get, we roll over, then we'll get a bullish cross at a higher low point. Now, we might be lower here, and that would be great because that'd be a divergence. But in that particular case, then we look for bullish trades, right? We look for some bullish, maybe some long calls out of the money, so I don't have to put a stop order, so that way I can retest lows all I want. And then eventually, the idea is we'll get a good run up, potentially to like the 200-day moving average or beyond, for that matter. So those are the two things I wanted to point out. Again, a lot of things spike when the selling pressure is the worst, and one of them is the stochastic spike to the downside because we close. We have these big ranges, we close in the lows. Well, now that we go down, as we make another leg lower, it won't be so bearish. And that will give us opportunities on one hand for some high probability bearish trades that we don't need a big bearish move for. We don't need a big bearish move to the downside for short call verticals, especially if we can get out early with a 50% gain. But then it will set us up for a better, speculative directional long trades, bullish trades, as I need to add eventually some bullish deltas to my portfolio. All right? So that's kind of why I wanted to bring it up today. I think it's going to be very relevant within the next week on a short-term basis, as well as next week or two on a more intermediate basis, and with trade opportunities in both directions, to the downside first, and then eventually back to the upside. So for you premium subscribers that get all the custom content, like I said, I'm going to post that scan for you. And the directional can be either way, Linda. Directional is I need the stock to make a move for me to make money. All right, that's a directional trade. I need the stock to make a move for me to make money. Long trade means I'm buying it. I'm bullish essentially. That I kind of use that synonymously, even though that's not really the case. But I kind of use being long as being bullish and being short as being bearish. That's just my vernacular. So I link that together. Yeah, well, so that 8 day is a little bit of some resistance here. Okay. Tom asked a question really quick in the chat window. What percentage of my portfolio and is for active trading? So I use in this class, we use 10% of our total portfolio for active trading. Right, the rest is our portfolio management class, and then 25% of that is used for inventory. So 25% of my active trading portfolio is used for options inventory. So that's a number that I use no matter what. You might use like 25%. You might use 50% of your total portfolio for active trading, because your active trading, remember, includes trend trading. It includes swing trading, whether you're buying stock or you're trading options. So you might have a bigger chunk of your portfolio for active trading because you do some of these other trades. But if you do a lot of this like really small options trade, you don't want to have a big chunk because you have to make a bunch of trades to use your cash. And if you make a bunch of trades just for the sake of making trades, then you'll make a bunch of bad trades just because you're trying to use cash. So that's kind of the idea there. So 10%, because if you notice, I don't do a lot of stock trades, and the trend trades I make are with options. So that's kind of why I use a smaller number, 10% for options for active trading total, and then out of that number, a quarter of it I use for options inventory trading. All right. Well, again, that wraps us up for today. Thank you all very, very much for coming on class on a Friday morning. Q&A session tomorrow. You'll notice on the calendar that we don't have technical analysis next Friday. It's a market holiday next Friday. It's Good Friday. So no class on Friday, and any time we don't have a class on Fridays or Mondays, we don't have class on Saturdays either. So no technical analysis next Friday, no Q&A next Saturday because of the market holiday. So it's a long weekend. It's not like we're going anywhere, but it's going to be nice to just kind of play games and mess around with the kids here. They have spring break actually at the same time, so they don't even have to do online school next week. My wife doesn't have to teach, and so we're just going to be hanging around, and hopefully the warm weather will be able to get outside and maybe even get our hands dirty a little bit in the ground. Get out in the yard a little bit. Yeah, definitely go shoot some hoops. That is definitely on the agenda, boss. We do that every night. I take the boys over to the gym when no one's over there. We go late at night and shoot hoops. And then I come home and I'm like on the movies, where you come in, you strip down, and you get into the shower. So that's what I do every night now to avoid any infection. All right. Thanks again, everyone. Have a great one. We'll see you all tomorrow morning.